Here to discuss, JMP Securities Director of Financial Technology Research, Devin Ryan. Devin, thanks for the time. Obviously an important day. Markets making a bunch of decisions. I wonder, do you think the price action is illuminating liquidity issues or longer-term earnings pressures, which are getting better understood by the moment?
Yeah, good to see you, Carl. I think there's a couple things. I think there's a big unwind in interest rates right now, right? So asset-sensitive firms, I think, are seeing a lot of pressure today. Wealth managers that we cover and other names that benefit when rates are moving higher. I think there's a reversion in expectations there. And then you're also seeing, I think, some of the credit concerns creep in here with CDS moving on some of the financials. And so it's kind of twofold, but a lot of the things we're looking at on the balance sheets and we're talking about over the last week are not new issues. But obviously, the past week's been unsettling for markets. And so you're just seeing a higher risk premium, in our opinion, also getting put in terms of the PE multiples people are willing to pay.
Have you been making changes on various ratings? And how are you? I assume it's not, you're having to be, I guess, more selective than, say, moving just sector weights in the past.
Yeah, so, we're not moving ratings around per se, but, the earnings profile of a lot of financials is moving pretty abruptly just with how significantly interest rates have moved. And so we really want to, in this market, play the names that are the safest, soundest, best capitalized, best balance sheets, and then where you really have risk reward in the valuation. And so Goldman Sachs is one name that we like here. Stocks actually traded back down to book value. They will be a market share winner to the extent there's any kind of continuation of credit concerns. And so that's one we'd be looking at. But more broadly, the interest rate kind of dynamic that's been playing out over the last week or so is a view that maybe the rate hikes and the move higher over the last year is starting to cool off. And so names that benefited from that are clearly on the other side over the last couple of days here. And that's happening. We're seeing that today in a lot of the wealth management firms.
Citigroup's gotten beaten up. It's down more than 7% this week. Bank of America also 6.5%. Wells Fargo even worse than that. What is that a reaction to? Is it the lower rates? And do you think any of it's overdone?
Yeah, so I think what happened over the last week in the banking industry really was unsettling. And the banking industry overall is well capitalized. Most firms don't have the asset liability mismatch, if you will, that we saw with Silicon Valley. And so we feel good about the industry. But as I mentioned, this just really brings the risk to the forefront of a fragile market. And so we want to be really selective in this market and again, stay with the firms that have the strongest balance sheets. As I mentioned, Goldman Sachs is one. In this mid-cap space, we like Stifel, and there's some others. But, it's obviously a volatile time, and I think investors need to tread with caution.